short. Joining me, Kathy Jones and Joe Mazzola. Joe's a head trading derivative strategist, and Kathy Jones, chief fixed income strategist. Great to have you both here this afternoon. Well, let's talk some treasuries here first. To Kathy, no one coming to buy the bonds today. What do you make of that?
Well, it was kind of a bad setup for the bulls in the bond market because yields had fallen so much ahead of time and really had pushed down to a level that needed really good news on jobs, and we didn't get it for the bond market. We got good news and we created more jobs, and unemployment rate, edged up a bit, but overall it was a pretty healthy report, and that, of course, allowed the market yields to bounce back up. So we're back sort of in the middle of the range that we've been in for the longest time now. I think there's some resistance around 445 or so, just bouncing around in this range, waiting to see what the next move is by the Fed or when the next move is by the Fed.
I think that comment about the range is really important because if this type of sell-off happened at any other level above here in the yield, stocks probably wouldn't have taken it so calmly, Joe, but they did because I think we've seen this level. We've seen the dollar level here, and we're happy to some extent to see some good data after a month of general misses.
Mixed data is the way I would look at this at this week, Oliver. Absolutely, because I think heading into Friday, we saw a higher than expected jobless claims data. We saw ADP come in light, and job openings were lighter as well too. And then you pair that with some of the mixed data that we got from the ISM, and also what we saw from manufacturing services at PMIs, and it's a lot to digest. And I think the markets right now are just moving towards winners. They're pushing their chips towards the mega caps, stocks that have done well, and they're continuing to buy the dips in those names, and that's leading to concentration that, to be honest with you, we haven't seen in a while. I think I wrote in the notes here that if you look at Microsoft, Apple, and NVIDIA, now they represent about 20% of the value of the S&P 500, just those three names in their market cap. So, is concentration risk a bad thing? It doesn't have to be. It's just that you need to be aware of kind of how the indexes are moving. And while it might look like it's nice and calm on the surface, there's some churn below the surface that we're seeing. And, I think what we really need to pay attention to as we're heading into the next earnings season is, how high are these expectations for these companies? Can they live up to them? And if they can't, are we going to get enough of an increase or a trade up, right, from the other sectors that haven't necessarily participated? Or do we need these three stocks within those, the kind of the vaunted mega cap names to kind of carry going forward?
Well, to that point, some of the answer in there today after generally good economic data print, only 4 sectors kind of marginally higher. So not quite enough rotation to get that equal weight to follow S&Ps. But there's also inflation next week, so maybe limited until we see that figure. Seems like the message from bonds today is that cuts aren't coming anytime soon. At least one of the messages, Kathy, but are we still a couple prints away from having to revisit the April chit-chat about hikes again? I mean, what happens if next week comes in hot? Does this data skew us towards that or no?
I don't think so. I think the bar for raising rates from here is very, very high. So you look at where, say, 10-year yields are relative to core PCE right now. We're many standard deviations away from the median over many years, recent years. So we've already priced in or are priced for healthy economy, relatively sticky inflation, et cetera, at these levels. I think the idea that they're going to hike from here is a really low probability. So you have to look at the market in terms of probabilities, and I would say the probability of a hike pretty low, very low, but a hold, for much longer is certainly a probability that the market will go back to pricing in. We'll probably push out and expect only maybe one rate cut this year, maybe none priced into the market this year.
Seems like there's a big difference between us and the rest of the world at that point. Holding alone makes us stand out a good bit. I think that's obviously one of the big stories this week, Joe. I mean, it's just hard to envision why the dollar would go too far down. It had been slipping even with the ECB and Bank of Canada cutting rates. I guess market was kind of hoping we'd follow suit, but looks like today putting an end to that narrative because the dollar's ripping.
Well, you got to look at it this way, Oliver. Where are we coming from versus where are they coming from, right?
Sure.
We're coming from a fairly robust economy that, given the print that we saw today, is still creating jobs. And I agree with what Kathy said. It's all in the eye of the beholder, right? I mean, normally we'd be celebrating job creation to this level. It's just when you're looking for something in a cooler type of disinflation, and we get these piping hot numbers, at some point it's difficult for the market to digest all that. Although I will say this, it's done a decent job today, hasn't it?
Yeah, decent job. We're going to close up here basically, a little changed on the session. Appreciate you guys catching up with me on a Friday afternoon. Great stuff.